Hello, everyone, and welcome to yet another edition of Get Real with Jack and Cindy. I'm Cindy Morrison.
And I'm Jack Wallace. We're glad you're here.
Almost
We're glad you're here.
Yeah.
End of the year.
We have Kathy Burch here. Very excited to talk end of year finances, things that you can do, whether you're wanting to buy a home, buy or sell, whether you're an agent. She is my CPA and tax attorney, and she's fantastic.
Thank you. So CPA to the stars.
Yeah, something like that. Well, so let's jump right in. When it comes to the end of the year, what are some of the best suggestions you have that people can do at the end of year? Charitable donations, just wrapping things up as best as possible for this tax year.
Mm-hmm. I would say getting organized is the first step.
Yeah, Kathy knows I'm not the best at that. So go ahead. Yep.
So I would say, get organized. Let's see where we are. So let's, what's income, what's been expenses, where are we setting? So we know whether we need to find some deductions. Do we need to make some purchases? Would we want to set up a retirement plan? So I think just first of all, getting organized. And one of the things that I recommend for getting organized is setting up a business bank account just for your business, and then credit card just for your business. So then, you're really, you don't have to go through all your credit card statements or all your different bank statements. You just know where your income, deposit all of your 1099 income or your checks through your business bank account, and then pay all of your expenses through that account. And then, QuickBooks Online, most people are going to QuickBooks Online, and QuickBooks is actually the desktop is getting ready to, they're not going to be supporting QuickBooks Desktop anymore.
Oh, interesting.
So they really want to get that monthly subscription for the QuickBooks.
So that's Online. When you really suggest then for organizing QuickBooks?
Yeah, QuickBooks, because you can link that to your business bank account and you can download your credit card transactions.
Oh,
and
wow.
So it's so much faster now than having to data
input
every transaction.
I finally did that this year.
Awesome.
And I didn't end up doing QuickBooks. I ended up doing, Quicken?
Quicken.
Okay. I don't know how I ended up with that one, but wow. Game changer.
Game changer. Once you download it, you put your date range, you download it, then you just have to categorize it. Is it travel? Is it meals? Is it advertising? And then it will start memorizing it too.
So that'd be a good thing if someone hasn't done that, to get it ready to go for January 1st. You could start your year with that. I mean, instead of trying to go backward for last year.
It actually will go back. So you hook up your bank account and it'll go back. I think mine went
that'd be a way
2 years.
to organize your taxes for this last year by setting it up, and then next year it's on autopilot. That's a good idea.
But this year you could download all of your activity.
That's awesome.
And do it very quickly. And then you can see where you are, and then you can start making some decisions. Have I paid in enough in quarterly estimates? Do I need to buy, a new laptop? Do I need to buy a new cell phone? Do I need to?
So then, how does that work if you haven't? Like, if I do payroll through a payroll, company that does that. They take out every quarter and pay my taxes. So I don't really do like a true write myself a check. Does that make sense?
Yes.
So if you're doing that, can you do that, but then use the QuickBooks as your, just your business accounting? Does that make sense? What I'm saying?
Yes, you can. You can also, most payroll providers will allow you to download that information into QuickBooks.
Oh, cool. So then whenever they do it, then I just download that, and then it's like it did it too.
Exactly.
Oh, okay.
Yes.
Cool.
Yes.
That's great.
So.
And then you can
how much is it a month? Do you know?
There's different levels.
Okay.
So there's Quicken, and then there's some basic start, and so it just really depends on the level that you need, all the way up to enterprise.
Okay.
So
but for a basic,
I did just the cheapest one,
which is really what we need, just to keep track of stuff. We're not trying to really do any kind of super duper special accounting, right? But,
right.
Yeah.
And if you're not running payroll through there, then inventory or things like that, or where you need classes, like you have different locations that you need to track, profit and loss by location, you really don't need to spend a whole lot of money.
So then the Intuit the basic one probably would be just a good way to start.
I just did the absolute basic, and then it's cool because you go in and you can it's a meal. you can then categorize it. Is it a personal meal or was it a business meal?
Mm.
The other thing I started doing with it is I take a picture of every receipt and automatically upload it at that lunch
That's
or
great.
wherever I am. So I'm not trying to keep up with pieces of paper.
Yes.
To me, it just seems like more recycling and environmentally
So
healthy.
last year I did buy the receipt scanner.
Mhm.
And I use that and it's kind of the same thing. You just kind of feed it in, but then it's like I just have fed it and just stored. So that'd be in the next level. So
and then
that's
you can
great.
write like who was
I mean,
at
my
that
mom
lunch
always
with you.
did all their books with QuickBooks since I was a kid. Like she ran the construction company through it. It was great. I mean, she was able to do so much. So it's expensive to have somebody else do all that.
And it'll have the app on your phone and on your computer.
No, you should.
But you're the one who said.
Yes, no, you should do as much as you can yourself. I agree.
Yeah, the first time Kathy ever did our taxes, I like literally hand this to her, of course, the 11th hour, and her eyes were like, okay, you're going to have to do a little bit more work before you pass this back over to me. Yeah.
But because the IRS does not accept your credit card receipt as proof of, a receipt. So you have to keep those receipts. So that's why it's so important, to have something like that.
But you could digitize them.
Yes.
Okay.
And you need to, because by the time you got audited, a lot of those are on that paper and it's just faded, and so you can't even see what.
It's amazing. Even after 6 months, some of the ones I was going back and doing, I mean, they were almost completely unreadable.
You can't read them.
Yeah, it's crazy.
Disappearing ink. How
It
convenient.
Also, it just gets into a whole other realm with the IRS because it's like it's so amazing how we are held to such a standard that it's just so crazy. They don't want to make it easy on anybody.
No.
It's just crazy.
Yeah.
But
so how do you know at the end of the year, okay, I need to buy a car, I need to buy a computer, I need to buy a phone?
Unless emphasize need, not want.
Yeah, exactly. But for a tax advantage, is there any kind of like magical formula, or how do you know?
I just make my decision on if I'm going to need it next year.
Okay.
Do I need it now or am I going to need it in the future? So, what am I expecting what are we expecting income to be next year? Is it going to be, do we think it's going to be more or the same? Then you might as well go ahead and take the deduction this year because of the time value of money.
Okay.
And so you can go ahead and write it off earlier because,
you can use that money for investing or for whatever.
Mm-hmm. Yeah. Versus just giving it to the government. So, but also, for retirement, this is a good time to look at that. And because, you're just moving money from one pocket to another. Mm-hmm. Really, it's your money, but you're going to get a tax deduction this year, and then it's going to grow, tax-free in the future until you pull it out for retirement.
Makes sense.
So it's a good time to really look at that too. And see what kind of plan would be beneficial.
So let's talk about those different plans. What does that look like?
Well, there's for self-employed persons like realtors. Mm-hmm. You can do a SEP so that your net income on Schedule C, if you are a Schedule C filer, you can put 25% of your net income into a SEP every year. Oh. And so that's just a dollar for dollar reduction of your income. Yeah. Really great. If you're an LLC and your taxed as an S corporation, like you are, then you can put 25% of your wages. Right. And so you kind of have discretion on what you want your wages to be. Right. If you wanted to put $25,000 into a SEP, your wages would need to be $100,000. Right. But there's also something called a solo 401k, and that's if you don't have any employees, it's just maybe yourself and your spouse. You can do a single solo 401k, and you could put, I think this year it's maybe like $69,000 into it. And so you can put a lot of money into it.
And that doesn't have to be earned income to do that?
You do need to run a payroll.
Okay.
Yes. So part of it's going to be your deferral.
So it's similar to doing it the other way, except you don't have the 25% ceiling on it like you do.
That's right. Yeah. It's just a different formula where you can do your deferral.
Again, why do they do all that? Just make it straight across.
I know.
Why do you have to be so clever when it's the same thing? Like, it's just crazy.
And then it changes every year. You're like,
the dollar limit changes every year, what you can put in.
But I mean, you would think they'd be encouraging people to, I know they're trying to get as much tax as they can, but it seemed like they would be trying to encourage people instead of making it so difficult to know which one you can do the most for savings. But like, we live a lot longer. We need all these things. So
But
that
most of the
solo is
time-
interesting. I like that. So it doesn't give you the limitation, because I don't have that. I have just a normal
W-2.
Yeah,
Mhm.
yeah, that's cool. And you can do that in tandem with. That's the other thing too. Like if you had a Roth and you've had this, and then there's can you have that as the solo and then do a little bit here and a little bit there? You see what I'm saying?
Yeah, you could always do a non-deductible Roth.
Okay.
So, and then roll it, non-deductible IRA, and then roll it to a Roth.
Okay.
So at certain income levels, you can't put money into a Roth, or you can't, do multiple plans.
Right.
But you could always kind of do, it's called a backdoor Roth, where you put
Which is
money
what I've
into
been doing.
IRA,
Yeah.
roll it to a Roth.
I have my account, and I have the one that's not any kind of retirement, then the one that's a standard IRA, and then my Roth, and then the end of the year I just keep putting over from my ones that are not a Roth, I just keep putting it over to the limits.
Mm-hmm.
And that way, that's when I've been rolling it. So it's been kind of nice to make sure you're getting that deduction, but also moving that money.
Yes.
Because that tax-free at the end is so nice.
Yeah, so many people are looking at moving money from an IRA to a Roth as much as they can. And most of the time, when I've worked with financial advisors, they recommend, as long as you're in the 20% tax bracket, you should go ahead and roll from an IRA to a Roth if you're only paying 20%.
Yeah.
Because then that's growing tax-free, like you said, and it's going to be tax-free forever.
I just read a great thing. It's completely off subject, but kind of not. It's that whether you take the retirement at 68, 65, 62, 68, or 70, and like everyone's always saying, wait till 70 because you get more money. But there was a really interesting point. It was like, you really kind of get to that place where you might want that extra money when you're able to do more in that younger period, if you have enough money at the end, and that you could also take that money and be investing it yourself. And so is that really the best choice, to be delaying that money? Like you were saying, the time value of money. I mean, it just gets all to be so challenging to know what is the responsible right thing to do. But you just have to think about all that, and you have to think about it now.
Yeah.
Yes.
And if you're 20, please, if you're 25, 30, please put a little bit of money every month into an investment account. Just do it.
Yes.
And I think
Even if it
realtors are the
hurts.
worst, because we're feast or famine. It's not like we're a hairdresser where you're going to have this many appointments or whatever. It's feast or famine.
And we've all used that excuse, and it is just that. It's an excuse, because it's like you still have people still buy purses, they still buy shoes, they still buy, we still reward ourselves. And now it's like, for me, when I want to reward myself, I buy NVIDIA, or I buy, I just have changed my mindset, because you have to think about that. I mean, it's amazing how expensive it's. Like we were just talking before this aired about repairs on your house. Like that doesn't stop just because you're retired.
Right.
Like you still are going to need the money to support yourself. Now you can cut way back, and hopefully it is funny, the stuff I don't need now. I mean, it is funny.
that has been a theme for us this year.
How you needed an Hermes belt.
Yeah.
I no more need an Hermes belt than the man in the moon now. But it's like different phases of your life, right? I mean, so it is interesting. But I think so much time that we encourage young people to do the wrong thing by not, like, I just think it's so important, especially if you want to buy a house. I mean, because those are assets too, right? I mean, so you're not just building something. Everyone always thinks, well, you're not touching it until the future. But you're also building something that you can use to show that you have that money. I mean, it's still an asset to use when you go to apply for loans and things.
Right.
Even though it's not accessible, sometimes it is accessible. You can tap into it, but don't. But anyways, I'm getting off on a tangent.
And if you're young, I really encourage you two things. Save for retirement, and if you're going to have kids, save for college. Because that amount of money that you start when baby's born, the amount of money that you're going to have, and if they don't go to college, I don't know what happens with the money that you save if you put it in a certain account. Kathy, that's a
it
question
can go
for
into
you.
your retirement account.
Oh, it can. Okay.
That's a newer rule, but yeah.
Because college isn't for
It
everyone.
can roll into your retirement.
Okay. Yeah, college isn't
Am
for
I
everyone,
wrong?
but
Well, the 7,000 can
Yeah.
you can put 7,000 into a Roth, so you could move 7,000 over into your
Right.
retirement account, just like you could.
Still within so it's still within those regulations, but you're allowed to do
but I
which
wish
is awesome because
yeah.
you just disappear basically, or
Well, you'd have to
taxes.
pay. You'd have to pay a penalty on the earnings.
Yeah.
10% penalty if you pulled the earnings out and you didn't use it for education.
Yeah.
So interesting, but I wish we'd done that because even going to a state university at OU, it was 30 to 35,000 a year per kid.
Yeah.
And that's whoa.
I know what my parents did. We worked for the family when we were younger. I mean, like we had a construction company, so in the summers you'd sweep floors. My brother was nailing and hammering. I was sweeping floors. But the truth is, my parents then started paying us an income, and then did IRAs for us when we were 12 and 13. So it's amazing what you can do for to get kids started. And again, building their asset and collateral for the future with some it was minimal, but over the time value of money, it really adds up. So,
well, for 2024, you can pay minors $14,600 if they work for you in your business, and they don't have to file a tax return, but it's a tax deduction to you. And if you think about the time,
say that one more time because I love that. That's a really great thing.
So if you have minors that work in your business, you can pay them up to $14,600 in 2024, and they don't need that. Dependent does not even have to file a tax return.
Okay, so this is great. This is golden. So if you are, let's just say you're a realtor, since most of you that listen are, and you've got an LLC and you've got a kid who puts signs out, and they have to actually work.
Right.
You need to actually have, which is good for them to do. That was a very good lesson for us to do that. So if you have them putting signs out and doing those kind of things, then you can pay them $14,600. I love these random numbers. Not 624.32 cents.
Yeah, exactly.
Okay, so 14,600. So think about that, because then if you paid a kid that and put that into their savings account, and you did that over 2 or 3 years, and do you write that off as your?
It's on your wages line of your Schedule C.
And now think about that. That's amazing.
Yeah.
So you're deducting
dollar reduction.
You're just moving from one pocket to the other, but you're moving into that kid's pocket. That is important.
And we didn't
know
their
this. Money, but it is their money.
Till we came to Kathy, and it was like, oh, well, I've been paying my kids. I just wasn't, benefiting
and that's
from it.
Tax year.
This is this tax year, and then you could open a Roth for them, and you could put the $7,000 in it, and because of time value of money, I mean, every 7 years your money doubles at 10% rate of return.
So much. I don't have kids, but I love that. That is so
every 7 years your money will double at a 10% rate of return.
I mean, think about what you're doing for your kids.
And it's tax-free forever.
And that's incredible.
I mean, they would be a millionaire if you just did that every year, $7,000 a year.
And going back to, what's funny, my parents owned a lot of rental property. My mom still has a bunch of them, but the reason they started buying the folklore, is because my mom told my dad that she read an article, which is kind of interesting now because it's become true, that in the future, back in the 80s, that it was going to get so expensive that young people, when they got out of college, were going to move back in with their parents. And my dad said, mine aren't. And they started buying rental property. So, but it's so interesting because it's like, you're doing that for your kid, but you really could be doing something for them that's going to keep them from you having to. I mean, I keep reading articles. I read constant. I love to read all about this stuff, but about parents that are giving their 29 and 30-year-olds allowances.
Yeah.
First of all, that's enabling. Sorry.
Yeah.
But I mean, it's crazy to me in some ways. And I understand that sometimes happens in situations, but it's like they're like living in their basement and then they're paying them like a living wage. It's so interesting. So that's a really great thing for you to take the money off of your, like we were saying, how do you know at the end of the year? What a great end of the year thing right now to do in 2024 if you have that extra cash sitting there.
And it's a win-win. I mean,
Yeah.
your kids win, you win.
So if you put the 14.6 into a Roth, how much can you put into a Roth for them? 25%?
No, you can only put 7,000 into a Roth for them. So you can pay them 14,600
So,
this year,
yeah.
and you have until April 15th of next year to fund their Roth for 2024.
So then they'd have 7,000 in savings and 7,000 in a Roth. So
Yes.
even if you did, like, if you had a really good year, then you could do 14.6 this year. You could do 7 into the Roth this year, and then you could put 7 in. So like in January, you could actually put 14,000 in, 7 for 2024 and 27 for 2025.
The number will probably be a little bit different for 2025. It'll probably be 14,700.
Yeah. But that's great. I mean, that's a really, yeah, because sometimes if I have a really good year, what I'll sometimes do is I'll fund my Roth, I'll split it and do the past year and the current year and go ahead and just put it in at one time. And then that gives me kind of a year
early.
Just kind of see. And then like you have a slower year, maybe I won't do it that year. And then kind of it's weird when you play with it that way, but it works for self-employed.
And explain the difference between a Roth and IRA, some of the different things that we're talking about. What are they for people who are like, you're speaking Chinese to me.
A Roth is the only one you need to know.
Okay.
That's my opinion. Or maybe is a solo tax deferred?
I think that you can get a Roth solo now.
Yeah. To me, the Roth is young. The Roth means you pay the taxes for the year.
Mm-hmm.
You're not going to get a tax deduction putting the money in.
Okay.
But you never have to pay tax on the earnings when you take it out.
Here's what sucks is I bought NVIDIA in my regular IRA when it was 900% lower.
Oh my goodness.
Yeah. Throw up in my mouth right now. Yeah. But at least I'm thrilled to have it. But it's just funny. Like that Roth, it does make a difference when you start looking at that. When you go, if I had just done that one in there, then I would never pay taxes on that 900% gain.
And when your kids inherit it, say that if you pass it to them and they inherit it, they will never pay tax on it.
Okay.
So no one ever pays tax on the Roth when they withdraw it.
My mom always says, get it while you can, because the government's going to figure out this is too good to be true. Then that is why she is in the position she is in. Thank God. Yeah.
Yes. Wow. So one of the things that we've talked about, so if you're an LLC, when do you decide if you need to go over to an S Corp? And there is a time limit on that if you decide you want to do that for 2025.
Mm-hmm. If you want to be an S Corp, you have to make the election by March 15th of that year, at least by March 15th of that year.
Okay.
And so if you wanted to be an S Corp for 2024, it's too late. But for 2025, if you're an LLC, first of all, you would need to be some kind of entity to be an S Corp. And so you would most likely form a limited liability company.
Mm-hmm.
And then we would make an S election on Form 2553 by March 15th of the year that you want it to be effective. And I generally say you need to have net income in the six figures before it's beneficial, because you have to file a separate tax return if you're an S Corp, and then you have to run payroll for yourself, at least pay yourself reasonable compensation, and those things cost money.
Sure.
So you want to make sure that the cost of it doesn't outweigh the benefits.
So that can be a year to year decision then.
Well, no, once you switch over,
yeah.
you pretty much.
Because I always do S Corp, I think.
Mm-hmm.
I have someone like you, so I don't. Because what I just heard was Charlie Brown's teacher. Wah, 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 wah. I mean, I try to understand all that because I understand bits and pieces, but it's like, I really do think I've heard people go, you can do an LLC and you can do your own town. I don't. I think if you're going to go to that level to save money, you need to pay someone to make sure you're doing it the right way.
It's sort of like buying a house. Use a real estate agent.
Truly,
because it's it's a big
that.
investment. Same thing with your taxes and your business.
And I'm not saying
Go to
everybody.
the people who know.
I'm not saying everybody is in that place. I mean, like if you're making 30 or 40,000 as a realtor in the beginning, you don't need to be spending. I'm sorry, but you don't need to be spending that kind of money for someone to manage your money. But I think when you start going into the 100,000 and above, then it really does. It can make a huge difference in how much you pay and how much you're able to put into the future. And again, like we're talking about, it makes such a difference in the future if you save that 14,000 and you put 7,000 of it into a Roth IRA. I mean, just the time value of that is crazy amazing. And to think about, if I have a kid who's 12 and I put 7,000 into that account, think about when they're my age. I mean, even if you just did it one time, even if it's just 7,000 one time, and that just sat
It's going
there.
to double every 7 years.
Think about that. That's astounding.
Wow.
And that's, I think, could be conservative if that's just if you're doing sort of a standard S&P
just 10%.
index. Yeah. So, yeah, I think it's so exciting to me. You know, I was reading a great article today, Warren Buffett talking about the difference, how wealthy people think that poor people don't understand. And one of the things was he was talking about, and I love this, or they were talking about that, it's if you make $10,000, that we look at that as $10,000, that how are you going to spend it? And the wealthy mindset is, how is that going to be a multiplier? So how do I take the 10,000 and leverage it into 100,000 over time? Instead of how do I spend $10,000 in stuff, or and I think that multiplier is the great thing. Like, we have to think about, and so what you do, it costs people money to have your services, but if you're doing it correctly and you find the right person, they're helping you spend the money as a consultation in order to multiply your money in the future and make it and preserve what you get. I mean, preserve how much you can now legally.
And that's where, you know, like, my mind is a marketing mind. So I look at something and I'm like, okay, how can I market this? And that's the conversation going on in my head. So when we start talking about taxes and savings, my mind doesn't think that way. So that's why having somebody like Kathy on my team, is how I look at it, really helps that part of my brain that doesn't necessarily operate that way, doesn't understand necessarily all the ins and outs of that. But I've got somebody on my team who does.
But seeing, my favorite course in college was statistics. I love how numbers tell stories. It took me till stat 3.
How are we friends?
It took till statistics 3 for me to get there, because it was like all of a sudden I woke up in class one day and went, oh my God, median, average, like what, like, I love how when you look at all that, it's kind of like that, you know, like in movies where they show all the numbers and all of a sudden they line up in a column. Like, it's like when you start realizing this is what numbers do, like this raw data, and now AI, it's statistics on crack.
Oh yeah. Well,
how's that going to change your profession? I'm sorry, I interrupted you.
No, I was just going to say, but I think growing up dyslexic, that's where the numbers don't line up for me necessarily. I have to work extra hard when I'm doing
letters. Don't for me, but numbers always do.
Yeah. Yeah. So I do. I have to go that extra mile anytime I'm doing a net to seller sheet or whatever.
I totally get that.
You know, I spend time on that. Where marketing, I'm just like, I can do this.
Yeah. So how do you see AI changing your business or changing the taxes and all of the different things? Do you think it'll be anything substantial change-wise, or do you think it's going to sort of be the same story?
You know, I don't know. I really haven't seen any AI within the industry that looks like it's going to be substantial. So I'm not sure it's really.
Which is interesting. You would think that would be one of the first places it would go, would be into sort of accounting and numbers, because it's interesting.
I just see it now for like letter writing and responding to clients, but I wouldn't trust it right now that, you know, their answer is going to be the right answer.
Sure.
You know, it might sound a little bit better, but
because AI will make it up if it doesn't know it.
But
it will
somebody
make it
should develop that, because, you know, like we were just talking about all these different options. Like, you should be able to just go, I am self-employed, I make this amount of money, I have this many dependents. What is the best thing for me to do in the long run for my money? And let it go. I mean, because there's so many different options, but it's like, because even I can talk to 3 or 4 accountants and they all have a different opinion on what the best option is. You know, the other thing too that I think is interesting right now, and maybe this is only interesting to people my age and older.
Our age.
Sorry, you know, those 30-year-olds. No, like, you know, when you're younger, all you're trying to do is make as much money as you can. I mean, that is really like, you're literally just trying to on that hamster wheel. And then you get to be a little older and you start going, you know, I also would like to have some quality time, and I want to have some, you know, your priorities start shifting and changing as far as that goes, and just also your energy level, maybe, the ability to do some of that. So with that in mind, as an accountant, are you looking and thinking in terms of those trending, like how people are trending in their career path, and when they start getting not to, I think it's just like you're either working or you're retiring, and I don't think that's where people are anymore. I think people are working until a longer time, and I want to work for as long as I can to a degree.
Right.
But like you have to make changes in how you approach your taxes too, because if you're going from 200,000 a year to 100,000 a year over time, that's a different priority, right? And how you deal with things. So do you have any advice for people on that part of their life, on how are some of the best things to do?
Well, some of our clients, when they have started slowing down, they might not have needed S Corp anymore. So say that they were making more money, and so we might revoke that S election. Now we're trying to simplify. So because they don't need all of that anymore, so I may revoke that S election. Now we're going back to the LLC and just trying to simplify their life, so that they don't have to keep up with as much. We also can look at maybe rolling some IRA money to Roth, if they're at a certain level, so that it makes sense to get money out of that IRA at a lower tax bracket. We might look at selling some securities in a taxable account, because long-term capital gains may be at 0 at their tax bracket right now, with lower income. So there are a lot of different strategies you can use as your income comes down, that you couldn't take advantage of some of the other tax laws when your income was higher, because a lot of things get phased out. As you make more money, you're not able to take as many deductions.
And even right now, again, not being political, but just reality, we have a change in administration. There were certain things that were supposed to be rolled back under the Democratic administration that now may not. We may keep the Trump. I'm sure we will keep the Trump tax cuts. So those income brackets are going to stay where they are now, probably.
That's how.
And then you also get into the realm of you may need to think more about health savings accounts, because we may be looking at phasing down of some of our health insurance. We may go back to pre-existing condition being acceptable. It's just mind-boggling, all the things you have to think about. But it's like, some of those things, I think we've almost become such a self-serve society. Like I do all my investing pretty much I do all my investing on my own now. So I don't have that person that I'm calling saying, hey, Chuck, or Loren, or whatever, hey, what do I need to do with all this money? So it's like, then at the end, you guys kind of get all this dropped in your lap. Now what do I do with this puzzle that I put together, right? So,
well, I do think that we're going to have some tax cuts next year, and so just like bonus depreciation. So that is, we started out being able to deduct 100% of assets we placed into service, and then 80%, and now this year it's 60%. It's supposed to go to 40% next year. So I bet that'll go back to 100%, because with
which is good.
Yes, so I think a lot more. There'll be probably a lot more favorable laws for business owners.
And that's been the hard part for me. I again, this is not political. I have my pocketbook and I have my heart. You have those, and then you always have to reconcile those two. But the one thing I will say is, as a self-employed person, the system seems to really be sort of set up for either the ultra wealthy, who can do so many tax structures that they pay almost nothing, or it's set up for people that are just the normal, here's my taxes, here's my deduction. So that people like us in that middle zone, it really does make a difference. Those subtle things make a huge difference in whether we get to keep putting money back into working capital or pay it into taxes.
Well, the great thing about your business is that most of the Internal Revenue Code and the deductions are for business owners. And so you're considered self-employed. And so you can take advantage of all these deductions. And if you're an employee, you can't deduct any employee business expenses anymore, because those were itemized deductions and they're phased out. So that's the great thing about being a realtor, is that you can take advantage of all these business tax deductions deductions. Anything that is ordinary and necessary that you use in your business is just a direct deduction.
I had a great story of somebody who got a realtor that got audited, and they went through their things, and they ended up owing the government and owing them a lot of money because they were like, you didn't write this off, and you didn't write. I mean, like they had a lot of things that they didn't do. It's kind of an interesting thing
because you don't know what you don't know.
And this person was so afraid of doing the wrong thing that they weren't putting it in the. And so it's kind of funny how if you really work the system the right way, and again, all legal, but yeah, those are legitimate. It's hard too because again, I love the idea of the credit card being. I need to be better at that because I always have to sort through my stuff. But like to think about one credit card is all of that because then it's just so autopilot. Because a lot of times you go, well, I don't know, I'm not going to worry about that. But you did spend $13 when you were here because that's something that you can put in your office for
and home office deduction too. So a lot of people used to consider that a red flag. Well, with COVID, everybody, was working from home. It's not a red flag anymore. So if that really is your office, you should take advantage of it and deduct it. You can either deduct $5 a square foot for that office, or you can take a percentage of your real estate taxes, mortgage interest, all of that, and the square footage of your office divided by the square footage of your house and deduct that. And so it's a legitimate.
Now, do you have to have? I may be really outdated here because I haven't dealt with it. But do you have to have a separate outdoor entrance to your office?
No.
Do you, at the end when you sell your house, do you have to go back and repay any of that?
Yes. So right now, when you sell your house, a single person can exclude up to $250,000 of gain on the sale of the residence, and a married couple $500,000. And so that portion that
which again is the most amazing thing ever.
Code Section 121.
That's better than a Roth, kid. That is better than a Roth.
So the portion that you have depreciated, you will recapture that. So the depreciation will just be, a time value of money. You're deducting it now and you're picking it up later.
So if you're really selling your house quite often and doing that and doing it as an office
every 2 years
could be a little more complicated than if somebody's But so let's go back because I love this. This is when I am the worst. I've been in my house for like 18 years. But if you can do every 2 years and make good luck making 250. But especially if you're a couple. But if you can make 100 or 200,000 on a house that you've lived in for 2 years and then put that just keeps rolling tax free.
Yes.
What other investment there's no other investment.
No.
That has to be your primary residence for 2 of the last 5 years.
Yes.
And that's really important. And that means getting your mail there for 2 years. It does not have to be consecutive, right?
No.
So you could have a year there, rent it for 2 years, move back for a year, then you've got your 2 years and then sell it. But when you sell it, that's your profit. So if you put a roof on, if you do plumbing, if you do, legitimate repair or improvements, then those come off of that. So it's not just the purchase price and then the sales price. That's amazing.
It is amazing.
That is better than a Roth. And
why
rarely say that.
Why are we still in our own, our houses? I've been there 26 years.
Same one. But it's also, Oklahoma has not been as some other markets have been a little bit better for that as far as the cumulative. Like you still have the issue now. I think that if you're not for me to move from my house right now to find another house could be challenging for me to find what I want. You know what I'm saying? So I think it's been a little bit different for Oklahoma, but I have friends who have made so much money moving across the country, and they were with a company that did their relocation packages. So they paid for a lot of their expenses on the moving stuff, but then they took the gains. I have a friend who retired really, really wealthy, and he always says, I retired wealthy not from my pension or from my salary, but from all the moves that they had me do, and he would just make money wherever he would go. So, there's so many ways to make money, and you have to be thinking about your taxes. There's so many interesting things, and that's what I think sometimes that as realtors, we don't preach as much that advantage, because that's a huge advantage.
It is.
And it's never challenged, really. I mean,
Sometimes people think you still have to roll it into another house, and you don't.
oh, that's important.
That was
Thank
that was the
you.
old rule, that you had to
Yeah.
buy a house that was just as the price was equivalent, and you don't have to do that anymore.
So at a certain point, people stopped because they were like, I don't want a bigger house. I've
Mhm.
done it, which was a dumb rule.
It was.
I mean, but it was in place forever. Yeah, that was like, what, 20 years, 15, 20 years ago?
Yes.
Yeah, but yeah, that's important. You can, and you don't ever have to put it in anything again.
No.
You just get to keep it.
And it used to be, you had to be in a house 5-7 years before it really appreciated enough for you to make money off of it. And now, I mean, they're going up, what, 5%, 7% a year?
And that's what in some communities where the houses have gone really high, I've heard of people that are in retirement age are selling their house, taking that ability, taking the money they made and putting it in investment, and then moving into like a community or a rental, but they have their nest egg now out of their equity from their home that they're living on and investing. I mean, it's a game changer for so many people, especially if you're a couple and you could, if you lived in Phoenix, you really easily could have made $500,000 in 20, 30 years of living in a house.
Mm-hmm.
I mean, so that's a big deal. Isn't it fun?
Yes.
Okay, now I'm ready to move. Just kidding.
See, I'm a geek. I should come work for you. I love this stuff. All I need is another career.
And charitable deductions.
Give.
Yeah, here before the end of the year, make sure, if you're giving to Goodwill or whatever, get it there
Or the
before the end
Christian
of the
Center
year.
with Broadway Boot Camp.
There you go.
Arts and
Exactly
Education Fund.
Yes. So if you itemize your deductions, instead of taking the standard deduction, definitely get keep your Goodwill receipts or Salvation Army receipts. So they do add up. And, a lot of people think that you can only deduct a certain dollar amount. That's not true. You can deduct, you can deduct as long as it's good or better condition, and you can deduct as much as you give. So there's no limit. I mean, there's an overall limit, but it's not just $500.
And that Goodwill form gives you all the values and all those things. I mean, you do have to fill it out if you were going to, want to keep it. But oh wow, I love getting older. My brain just loves to let go of stuff.
And I watched it fly